Okay, let's make a start. Again, good morning, everybody, and thanks for joining uh, KPMG's text webinar. I think, as you're aware, we have been running these webinars for the last few months, so it's a continuing webinar on the series of topical tax issues that we are discussing with the panel of experts that we have within KPMG, and obviously picking your questions, the questions that you know, drop to us through the chat box. And we'll try to cover as much as we can within the next hour. As an introduction, I am Zubair Patel. Obviously, I went through the list, know quite a lot of the people who are joining. And but for the other people who don't know me, I'm the head of tax at KPMG in Kuwait. And obviously, I'll join by my colleagues here, which I will introduce as we move forward. But just to cover what this session is all about, obviously, it's the key tax implications for the ONG, the oil and gas, and the EPC contracts. So I think while we've been running previous sessions on tax retentions and on other tax aspects, I think in this particular webinar, we will try to dive into a more detailed tax discussions on the key implications, particularly for foreign corporates who are engaged in this oil and gas sector, as well as the engineering, procurement, and construction sector. So I think we'll look at the various um, executive circulars and the legislations around, and what are the actual practices the ministry is taking on these sort of companies in this sort of sector of business. So Misbah, with that, let's maybe go to the next slide, possibly. Yes, so I think just to, I guess, reiterate what I just said before, this planned is 45-minute sessions in line with what we have been doing in the past with our webinars, and that would sort of continue. And again, please use the chat function to ask any questions. We will try to answer whatever questions that we can answer within the time frame. Of course, covering all the technical content that we intend to cover. And of course, there are any other questions, you can obviously reach out to the colleagues that are going to be speaking to you shortly. The session is being recorded and will be, shared, um, uh, on the social media channels that we have. We will send the links to participants following the sessions, and the training materials are KPMG's and obviously should be used within that context. So the next slide, please. Yes, before I hand over, I mean, obviously you'll be in the safe hands of Fahim, who is a partner at Tax and Corporate Services. We have also with us Hanan, who is a director within the Tax and Corporate Services, and Naveen. So they'll be obviously speaking to you shortly on their specific topics where they are the specialists. We've got quite a lot of experience with Fahim, having more than 15 years of experience, and pretty much Hanan and Naveen as well. As you can see from their credentials there, that pretty much 15 years of local experience as well. So I think with that, if I may, I can hand over to Fahim to take matters forward. So over to you, Fahim. Thank you.
Yes, hi. Hello, everybody, and hope you can hear me well. Um, yes, this is a third in our series of Kuwait tax webinars that we've been holding every 4 to 6 weeks. It's always good to set the scene and give a bit of a background at the start of each of the seminars. And then we'll go deep into the technical topics today. We are making it a bit more technical today, so it's going to go into a lot more detail of the specific executive rules related to oil and gas and EPC sector contracts. But just as a high-level background, the Kuwait tax law is very brief. Okay, it doesn't talk about permanent establishment. It doesn't talk about residency concepts. It talks about contracts wholly or partially executed in Kuwait as being subject to tax in Kuwait. And effectively, even a single day's presence creates the obligation to have your tax filing and triggers your registration and compliance procedures. Misbah, you can show the full slide right now. That will be fine. Yeah, that's great. So, when we talk about obviously oil and gas and EPC contracts, we're talking about long-term contracts. Inevitably, these will be contracts for which tax filings are going in. And in line with the in-country presence, there's potential adjustments and planning opportunities with respect to tax treaties, which we'll also come on to later in this presentation. Now, the other thing to keep in mind is also, there are certain types of income that are taxable on their own right, irrespective of presence in Kuwait. So such as license fees, royalty income, so technology-related income effectively. And what we do see is in oil and gas and EPC contracts, you have sometimes related party tools, technology being charged into the Kuwait project. So what are the tax implications around that? I think that is also something that sometimes gets overlooked, but it's important to analyze and capture all income streams from the group and related parties. So the other key point that obviously comes up a lot of the time is the tax retentions, and obviously these contracts typically with Kuwaiti government bodies, the main contractor is likely to retain 5% retentions on the contractor, the main contractor, until the tax clearance certificate or the no objection letter is received, and that happens at the end of the compliance process. For each year, it's amount specific, and can lead to obviously a lot of trapped cash in terms of retentions, if the compliance process naturally will go on for a couple of years, given that these are long-term contracts. And the key that we'll get into as well in a couple of slides is the focus on this tax retentions and the ability of the tax authority to disallow expenses where compliance has not been done. So where clients have potentially missed retentions or are not applying them in the way the practices of the tax authority expect, then potentially how does that impact your bottom line tax liability and overall profitability of the projects? Yeah. So next slide, please. Again, setting the scene a little bit with respect to oil and gas and EPC contracts. These are long-term contracts. We're looking at medium-term contracts, 3 to 4 years, 5-year contracts. So it's going to entail a number of tax filings and a number of tax inspections. And obviously, the more this carries on, is a lot of pressure on the finance team, on the administrative team to provide the relevant documents to manage the process, and obviously the ongoing cost of compliance throughout the phases of the contract. Clearly, if these are multiple-year contracts and the tax authority, typically looks to inspect contracts in bulk, so they're looking at 2 to 3 years in one go, you may have retentions being tracked for a number of years before you're able to get your assessment for each year, before you're able to get your no objection letter and the release of that retentions. So 5% of revenue can obviously be significant. It is worth planning for up ahead when you forecast and budget cash flows for the project, as this is again an area which impacts a lot of our oil and gas and EPC contractors. The inspections are very detailed, so it requires robust documentation on all the transactions throughout the life of the contract. So a lot of details on costs. Even if the contract has not changed in its nature over the years, the tax authority will look at revenue, they will look at cost each and every year, and do their full inspection. And because of the size of these contracts, typically we will see that inspection can take a while and heavy on resources for both our clients and us as well. Typically high value contracts, so it is large value contracts that we're looking at here, predominantly tight margins. When you look at, there is a definite risk of cost overruns and delays that can potentially see losses being realized. If you then add on top of that any adjustments that the tax authority do and not allow specific costs, then obviously that impacts the overall profitability of the project. And commercially, if accounting you have a loss and you are still paying taxes, this becomes a challenging position for clients. Subcontractors is a key area, and we're going to spend a bit more time on that. Main contractors have the contract with the end user, but typically you will see many vendors, many subcontractors being involved, which entail their own compliance and entail compliance for the main contractor as well. So I think Naveen will go into that in the next slide. But typically, just to say that focus for subcontractors and the other area is related party transactions, which again, we'll go into a lot more detail with Hanan later in the presentation. These two areas typically cause the most demand in terms of documentation, most areas of discussion with tax authority with respect to potential adjustments. Related party transactions, whether it's head office, affiliates, branch, head office transactions, it's covered. All of this is covered, whether it relates to materials, technical services, design, engineering, regional charges, head office charges. All of these are areas which are a key area of focus for the tax authority during the inspections. So whilst there's no formal transfer pricing regulations in Kuwait, when you look at these executive rules, they talk about imputation of profit and expected margins on certain transactions. So whilst we don't call this transfer pricing, it's definitely a focus of the tax authorities to look at related party transactions and ensure that they are reported correctly and apply relevant profit margins to those. Yeah. So with that, I think we will hand over to the next slide, and Naveen can walk through the issues around subcontractors and specifically Executive Rule 28. So over to you, Naveen.
Thank you. Good morning, everyone. As a part of any EPC or any kind of contract, what we see that either the company will perform the contract on its own, or a portion of work could be subcontracted to any other parties. It could be third party, related party, or we use the word head office also do some part, but again, that comes part of their employees operating for that. The Executive Regulation 28 provides the definition of the subcontractor, and it's quite wide, which says that subcontractor would include any third party, provider, or beneficiary in any way that executes a portion of contract or any phase thereof is responsible for that portion. So by saying that, it covers into ambit any portion of work which is required to be done by the company in Kuwait, and if it is related to the portion of contract, that would be covered as subcontract. Now, while the definition is quite wide, but what we have seen that normally the tax authorities are expecting any kind of subcontract which is in the shape of it's a civil subcontracting, or it's a manpower hire, or if it is an equipment rental, it's a design and engineering. These things is what ministry is normally looking at very critically, while there could be other subcontracting, which could be technical services, etc. So it's quite widely covered, but normally the ministry sees these kind of activities or these kind of subcontracting arrangement, which has to be considered by the companies as a part of subcontractor. Now, what are the requirements for claiming these costs? So the main thing is that the contract should be directly related to the main contract. That's the first thing. And the second thing is it should be backed with the proper documentations. So maybe the copy of contract, normally the tax department review, the invoices, the proof of payments. And then the key thing what they would like to look at is whether the company has retained 5% on these kind of contracts or while making the payment to the vendors. That's the key. So if these things are met, then normally the tax department would accept the cost. Where the retention is not made and tax clearance certificate is obtained, then it should be fine. And you should be able to link with your contract that how it is related to, either it is part of your approved subcontractors list or not. That is also the tax department is looking at. So this is how the cost is being reviewed by the tax department. The second thing which practically what we see the tax department is looking at as per the executive regulation is that the cost of the subcontractor should not exceed the revenue for subcontract. So effectively, if a company takes up a contract in Kuwait, the tax department does not expect that the company would making a loss. While commercially you may, but looking at the practices of the tax department is becoming very aggressive on the cases where the losses are there, and they apply the circular. So normally, for example, if a company is having a contract of $1 million and the subcontracting cost is coming like 1.5 million, and then the loss is declared as 500,000, the tax department would attempt to make a disallowance of that 500,000 of loss coming because of that reason. Again, the losses could be attributed for various reasons, that there could be the loss on the material or administrative cost. So if a matching revenue which is not provided in your subcontracted in the contract, then the ministry will apply a formula, and whatever is loss attributable to the total revenue, the ministry will apply the formula and disallow the losses because of the subcontract in that reason. Now, having said that, there are some practical challenges what we see. So one is, if the companies are normally required to provide the list of contractors through a tax returns and return to the Minister of Finance, or periodically, it could be quarterly or yearly. And the second part is they should retain 5%, as I mentioned, on the invoice value. If these things are not met, then the tax department attempt to disallow the cost claimed in the tax declaration. Retention of 5% is expected on the invoice value. So if a catch-up retention is done in the subsequent years, in practice we have seen the tax department is not accepting those costs as deductible cost. So this becomes very critical. Defining subcontractor, as we mentioned, that is quite broad. So one may need to look at what is subcontractor. Normally in practice we mentioned that civil contract, manpower, equipment hire, these are normally looked at subcontractor. And losses, as we discussed, if it is because of subcontractor portions there, it is not allowed. So in summary, one need to look at a planning at the commencement of the contract, that if there is a loss on the contract, how you structure your subcontracting in a way that the losses are either if there is a losses, then it is bifurcated over the period of contract, if it is possible commercially. Retention has to be made. Any related party subcontract is done, then 5% retention has to be made, and you need to look at if that creates any filing obligation for those parties to release their 5% retention. And lastly, normally we have seen in practice that the contractor should be approved by your contract owner, like KOC, KNPC, or any of the contracting party. In some cases, we have seen that the tax department is looking at these cases also. So yeah, this is from on the subcontracting side. Thank you.
So maybe Hanan, I think now you can take forward on material adjustments and the design and consultancy circulars. Hanan, over to you.
Thank you, Fahim. Thank you, Naveen, for the explanation of ER 28. This is one of the important executive rules under discussion with tax authorities now. From my side, I think there is another two important points for ER 25 and 26. I would like to highlight some challenges which normally companies face on computation of such imputed profits on suppliers, design, engineering, and consultancy services provided from outside Kuwait. And Fahim rightly highlighted in the start that in Kuwait, we don't have separate transfer pricing regulations. So there are some internal guidelines, executive rules provided by tax authorities to compute such profit margins on imports from head office, related party, and third party. So we'll try to provide you with a simple example to understand that how tax authorities compute this imputed profits, and also that what kind of practical challenges currently companies are facing on the disallowances applied on this. So we have the recent regulations, you can say, is executive rules issued in 2013, where first one, ER 25, provides disallowances on imputed profit calculations guidelines on imported equipment and material. So if you see on the screen that if a company importing material from outside Kuwait, they are required to have a minimum imputed profit margins applied. As Wahim highlighted in the start, if you have a double taxation treaty in place, then this executive rules will not be applied. This is only for the companies where there's no double taxation treaty benefits available, and certain imputed profit margins are required by tax authorities to be applied for any imported material, design, engineering, and consultancy services provided from outside Kuwait. So in year 25, you can see if a company is manufacturing or they are importing some material or equipment from outside Kuwait, there is a restriction. You can say the minimum 15% imputed profit margins are required to be applied. 85, it means that 85% of the cost compared to the revenue will be allowed. Same if they are importing something from related party, then 10% imputed profit is required. From third party, that margin reduced to minimum 5% to be applied. In case of material and equipment,
Now,
it's really sure, Zubair.
apologies. I think just one of the questions which, obviously comes out from our clients from time to time is, the third parties. I mean, 95%. I mean, I think the question is, have we had the discussions with the ministry? Have we had 100% allowed on third parties in practice?
This is very tricky question, Zubair. I know that still in current COVID situation and based on the current inflations and all the companies, they are challenging this imputed profit margins. Frankly speaking, 5% in this current situation is still, it's very difficult for, especially in construction sector to maintain. We have many cases where companies challenge this imputed profits. We have some successful cases as well, but again, Zubair, it depends on the nature of the contract they are performing in Kuwait, what kind of equipment or material they are importing in Kuwait, and a lot of other factors. I agree with you that there are cases where tax authorities has given that that exemptions on that as well. But yes, as per the guideline, minimum 5% should be applied on third party.
Yeah. So in the absence of transfer pricing rules, I think you're saying it is really going to be how robust your back underlying documents are and how
Exactly.
your discussions are.
This is one of the difficulties or challenges you can say companies. We will be covering this in practical challenges because I agree this is one of the hot topic nowadays with companies, especially with COVID situation. I agree with you, Zubair. Yeah. So the second part that how this cost is calculated. In case of material supply, normal understanding is that the cost of material coming from outside Kuwait is the only cost which is considered by tax authorities. But if you see the guidelines, any cost related to that import, either it is custom duty, freight cost, any insurance paid on that import of equipment or material, any transportation, or any direct related cost is also calculated as part of the cost. So that is also one of the challenge which companies are facing to compute the imputed profit on that. Same in design and engineering as well. You can see that this margin is increased from supply because tax authorities stance is that there is more margin in design and engineering services because of use of technology. Nowadays that margin is increased. So from head office, they are looking for minimum 25% margin. From related party, you can see 20%, and from third party, minimum 15% imputed profit is required. In consultancy, again, it's more than design and engineering one. Head office, minimum 30%, they're looking for such imputed profits. Related party, 25%, and third party, 20%. If your contract is providing the split of revenue, like how much is engineering, how much is procurement and construction value, or whatever you're billing to your contract owner, then straight away tax authorities will apply the percentages of imputed profit provided in the guidelines. In case that it's difficult to separate your revenue, that how much is from, because sometimes the invoices are all together, some part of the services and material is very difficult to compute separately. So if you have a lump sum value of revenue reported in your tax returns, so there is a formula provided in the same guidelines that how to compute such material revenue or engineering revenue through that formula. So if you see on the screen that we have how it is calculated, that whatever cost incurred for that service, like import of material, supply, design, or consultancy, divided by direct cost, which will give you a percentage of the cost, and multiply that with contract revenue. So whatever amount will come, they will consider this as a revenue earned for that specific supply, design, engineering, or consultancy services, and certain imputed profit will be calculated based on how much is imported from a head office, related party, or third party. Misbah, if you go to next slide, we will try to give one simple example so they can understand that how the overall calculation is done by tax authorities. So the first simple example we have taken that if on the basis of assumption that material and equipment is transferred from head office and there is no EPC split provided in the contract, specific contract which company is submitting along with the tax return. So you can see on the screen we have assumed that there is a revenue incurred for the year 2 million and direct cost incurred 1.8 million and some other cost incurred $500,000. So total cost is 2.3 million. It means that company is reporting around 300,000 loss on this tax return. And from the direct cost, material cost is imported from head office, and the value of such import is 1.1 million. We also know that there is a custom duty paid on that, which is around 5%. There is freight and other material cost charge on that, which is around 45,000 estimated. So in this specific example, we are saying it will be 1.2 million overall material cost incurred from head office. Where in the absence of material revenue, DIT will apply the same formula which I highlighted in the previous slide. So you can see that 1.2 million, which is a total material cost or equipment, import of equipment incurred, they will divide with the direct cost 1.8 million and the revenue 2 million. So you will get a material revenue, which is 1.3 million, 33,000 approximately. Then they will apply 85% on the basis they have to calculate 15% imputed profit on import from head office. So if you calculate that, it will be restricted to 1.1 million 33,000 in this specific example, and compared to 1.2 million actual cost incurred by the company for import of material from head office, only 1.1 million will be allowed, and this will be resulting into 66,667 Kuwaiti dinar disallowance. This is how the calculation works.
So,
Sure,
if I
Zubair, you
may,
want to-
so I think another point I think which obviously comes up, and we just wanted to share some practical insight. I guess particularly the construction contracts are obviously very tight margin, particularly. So I think that's a very important point on the disallowances. So I guess the recommendations for the construction industry, particularly, I would say, is that please have a look at the executive rule number 25 on the potential disallowance. So you don't get any surprises, isn't it, on the margins that you make on these contracts. And we see sometimes the new companies, falling down, particularly the new entrants into the markets, falling down on that. Yeah.
I agree with you, Zubair. This is really important point to consider. Misbah, if you go to next example, maybe we can highlight one before, please. Yeah. So same in year 26, the guidelines are provided for design, engineering, and consulting services. So one of the example we are sharing with you now here is design and engineering costs provided by third party from outside Kuwait. So in the same example, we are saying the revenue is around 2.2 million, direct cost is 2 million, other cost is $500,000. So the total cost incurred is 2.5 million. Again, to give you a better example, we are putting in some losses, around 250,000 losses on this example. Then there is a design and engineering cost incurred by third party, which is 950,000. Same formula, instead of material cost, they will calculate the actual cost incurred on design or consulting services divided by direct cost into the revenue. You can see it will be approximately 1,068,000 allowable cost, which is allowable revenue, which is material or design engineering revenue calculation, same like we did in material cost example. And imputed profit, if you see on third party, in case of design and engineering services, is 15% minimum. So it is restricted to 900,000, 800,000 something, 900,000 approximately. And your actual cost in this example was 950,000. So if you see the difference is 41,000 cost will be disallowed by tax authorities. If you move to next slide, Misbah. Now, as Zubair was highlighting, there are many practical challenges which companies are facing right now. In case of material supply, it's very important that you know what is the source of material. If the company is manufacturing such material, definitely there will be a margin will be there, and then you know we can say that this is import from head office. But what is a common mistake companies, especially in construction sectors, are making? They are not manufacturing industries. They are buying such material from third party, but this material is routed through head office. Head office will be based on their head office margin, discounted rates uh, received by head office. They are buying on bulk this material, but these shipments are transferred from head office. So while computing the imputed profit on that third party purchase, when all the documentation is coming from head office, tax authorities, based on ER 25 guideline, they will be considering this import from head office, and same 15% imputed profit will be applied. So this is where I think companies, if they plan properly on that purchases, they can save this kind of disallowances.
So, Hanan, I think
Sorry, Frank.
this brings up a good planning opportunity, isn't it? Just to make sure, just from a procedures perspective and accounting function, making sure that the chart of accounts, the internal accounting function is defining the source of material in the right way, yeah? Because as in when you come to the inspection, that makes it a lot easier to identify and present the documents, yeah? Yeah.
I
So
agree
again,
with you, Frank.
something that needs to be known upfront, yeah, yeah.
I agree with you. This is why I think companies, before they bid for the contract, they should know the local regulations. In this specific example, they can easily lose 10% disallowances. If they plan it properly, the same shipments which is coming, actually it's purchased from third party or related party. If it is routed properly based on the regulations and documentation is prepared based on the guidelines of tax authorities, they will not have this kind of challenge. Second, on one of the common, I think, discussion point is material on transit. Sometimes when companies are purchasing equipment or material from related party or from head office, in terms of accounting presentation, what they do, the company, once they ship the equipment, they will book their cost, and such cost will be allocated to the Kuwait project or Kuwait allocations. But this cost will be booked. But unfortunately, based on the guideline provided by tax authorities, any material which is in transit, it's not allowable as a cost. So this is where I think most of the dispute happened with tax authorities. Such cost will not be allowed as chargeable cost until such material is reached Kuwait ports, or there should be evidence like custom bans or any documentation from the contractor which will confirm that such material reach the project site. Then again, one of the application on finished goods, frankly, in case of manufacturing, again, this will be applied on the finished goods, any raw material, any other material which is not related to finished goods, which it will not be allowed as chargeable expense. Then again, on manufacturing industry, as we highlighted, and Zubair was highlighting the same point, that actual margins based on the current inflation, competition in the market, and especially in last 2 years in COVID situation, in pandemic, we know that calculate this kind of margins, even from third party, 5% margins is very difficult to maintain. So these disputes are also common with tax authorities, and companies are now discussing this with tax authorities to, consider this imputed profit margins. Then other, sorry,
Practically,
Zubair, you want to add something?
I was just going to say the cash flow challenge that I've seen. I think if we talk about and give a the clients that have joined us, the challenge here is that if you've got quite big disallowances happening, then the actual impact on the liquidity, not only the profit, is pretty huge. And I think I've seen that impacting the cash flow returns, etc., on these contracts, particularly in the COVID times where cash has been a bit scarce. Yeah, so I think and I think this needs to be really looked at upfront. So if supposing a financing requirement does arise, that is dealt with, sooner rather than later. Just a note to the participants, whilst we are going through this, if you have any questions, do sort of raise it in the chat box, and obviously effectively putting the host, I think, as the person that you are addressing it to. So hopefully that would come through. Yeah. Okay. So I think
Yeah, Zubair, I think this is one of the important point. If they don't understand the regulations, they will end up with huge disallowances. I think you rightly highlighted, and this is actually happening. So I think this can be opportunity for the participants to at least understand the regulations, and we are there. And even after this webinar, if they have any questions, they can drop us email, and we can explain anything related to their project. Another dispute, Zubair, is that how to calculate the cost of supplies. General understanding is that whatever they are importing related to CIF costs and all, this is only calculated by tax authorities. But as we highlighted in the guidelines and regulations in previous slide, this is not the only cost tax authorities consider. Any cost which is related to import, including custom, freight, insurance on import, even a bank guarantee if they have paid on import of such material, is considered part of that cost. And that imputed profit margins are applied after calculating this total cost. So this should be considered by the companies while preparing or budgeting the cost. Another point is supporting documentation. You have your shipment coming from outside, you have your cost incurred, but if the documentation is not properly available, that cost will be straight away disallowed by tax authorities. It doesn't matter what imputed profit you are reporting. And again, 5% retention point, which Naveen highlighting in previous slide, that should also be considered while getting material from related party or third party. So the custom documentation, as I mentioned, it's very important that if you have cost incurred and you have all the shipping documentation, the custom documentation, which will confirm that that such material reach Kuwait ports. It's really important document while presenting your cost to tax authorities. And again, the direct. Sorry, Zubair, you want to add something?
No, yes, I think I'm saying that's correct.
And again, I know that some of the participants, some of the companies in participating in mega projects, their question will be that how the direct cost is calculated. Now, frankly, in the law, it's not defined that what will be the direct cost, but any contract cost which is incurred on the project is taken by tax authorities as a direct cost. Sometimes we have seen in addition to subcontractor, equipment rental, or manpower cost or material costs incurred by the company, they are also taking equipment rental or vehicle rent, which is part of the project. So any site cost incurred is also taken as a direct cost. So again, your computation will change based on the direct cost incurred on the project. Some warehouse rents are also sometimes considered as part of direct cost. So it depends. We have a different practices from tax authorities. There is nothing defined. You can say that some tax inspectors, they are not taking some warehouse rents or vehicle cost incurred part of direct cost, and some of them they are taking this in the formula. Same for executive rule number 26. We have the same challenges. Defining the source of service is one of the case, and design versus consultancy. Because if you see in the previous slides, we showed you that if the same design cost or consulting is provided by head office, so the imputed profit margin is 30% in case of consultancy, and in case of design, it's 25%. So the documentation wise and the contract wise, it should be very clear that which part is consultancy, which part is related to actual design and cost. If the contract scope of work and all this is not derived as design and engineering cost, it will be taken as consultancy cost, and then imputed profit margins applied and the guidelines will be applied by tax authority. Some other thing that what constitute cost of services is not defined in ER. Definitely there is in ER 25 it's already provided, but in ER 26 it's not provided. So any cost which is related to engineering and design engineering will be taken as a cost. So in material cost, like it is defined, custom, freight will be added. In this one, this specific regulations, it's not defined properly. So again, it's open end to tax authorities. They can, any related cost, they can also add in the computation. Then supporting documentation from head office engineering, it's really important because it will not be like you're getting the services from third party where their contract will be there or there will be a invoice and payment proof. In case of head office, we have seen that many engineering teams are working on different projects. So some cost is mostly allocated to a Kuwait project. So for that, tax authorities normally required a proper timesheets, approval from the project managers, and such cost should be allocated through a proper head office debit note. And if you have a proof of payment for that, any cost which is incurred in head office and payment is paid from the Kuwait project, that will be again beneficial for the company while discussing with tax authorities.
Anand, there is so much to discuss on this, but I know that we are running out of time, so we thought we'll cover the slides because we've just got 5 more minutes left on the.
Sure. I think, Zubair, this is fine. This is one of the important topics. So any questions you have after that, drop us email or, ask any questions. We are there for you.
Sure. So I think, Misbah, if we move on to the next slide.
Yeah, if Naveen, you can
Naveen,
take,
go ahead.
you can cover this briefly. Yeah, absolutely. Naveen, maybe you're on mute, is it? Yeah.
Yeah, hi. Sorry,
Yeah,
there was some technical issue. Yeah, so thank you, Anand. Moving on, I think executive regulation leased assets. So obviously, we discussed subcontracting, something similar to that. Obviously, companies will, in addition to subcontracting, will lease some assets to perform their operations in Kuwait. Of late, what we have seen that so the leased assets are either acquired by a third party or they could be acquired by their head office or a subsidiary or any affiliates. So the common thing what we looked at or the challenge is what we see here is that if you acquire the assets from a third party, I mean, what the tax department is normally looking at is that you should have a proper agreement in place, invoices and proof of payment for them to review by the tax department, and the retention has to be made. If these categories of documents are being kept and retention has been made, normally the tax department would approve your cost and they will allow you the deductibility. The practical challenges comes in if the assets are being acquired from affiliate or a head office. So few things which has to be kept in mind from a planning perspective, both from the entity which is claiming the cost as deductibility and the entity which is providing the assets or related party. So when the assets are imported in Kuwait, they would have some custom declarations being done, right? So the lease charges are allowed not to exceed a depreciation value, which is provided at the rates allowed as per the tax law. So if you import assets in your books of a related party, could be $1 million, but if you import in Kuwait, if you import at $500,000 or $800,000, the tax department will look at the imported value as per the custom documents, and the allowable lease charge would be restricted to the depreciation rate as per the tax law in the range of 10 to 15% or whatever the rate allowed to the as per the tax law to that extent. So if you charge any lease in addition to the value which is declared in the customs, the tax department will restrict to the depreciation rate provided as per the law and limit it to the custom value. Like it will not allow as per the book value what you would have applied in your home country for the related party books. That is the critical. Other than that, all the conditions remain same, that the tax department will look at your invoice agreement in place, etc. So the critical thing one need to look at is the deductibility of the cost in their books. And the second thing is, if the related party, as they will be providing the assets, will be locating the assets in Kuwait, they would be creating, excuse me, a taxable presence in Kuwait, and they would be also required to file tax declaration. What we normally have seen, that when the related party would provide the assets while filing the declaration, since they will be only providing assets in Kuwait, they may not keep proper books of accounts. So as a practice, we have seen that the lessor are filing their tax declaration on a deemed profit basis. The minimum deemed profit acceptable by the tax department is 30%. If the tax department accepts minimum 30%, and if the real profit is less than the 30%, this is an impact we see on the project. So one has to keep in mind that whether they would file on an actual basis or on deemed profit basis. Actual basis, as the companies normally don't keep, the lessor doesn't keep books of accounts and file on deemed profit, that will be a big tax impact. So one has to keep that in mind for their planning perspective. But if you file on actual basis, one will need to look at that what is the imported value of the assets, and you claim a depreciation according to that. So that planning, that has to be kept in mind. That's one. And second, once the lessee would retain 5% while making a payment of tax, so there will be trapped cash until the lessor is able to file the tax declaration and get their retention release based on the tax retention release letters. So these are the few tax challenges we see from the lessor and lessee perspective, keeping in mind if it is a arrangement with a third party or it is an arrangement between a related party. Yeah.
Yeah. And I think when we look at the oil and gas and contracting EPC, it's, the rigs obviously come to mind. We see a lot of structures that lease in rigs to the operating company in Kuwait from an oil and gas perspective, drilling contracts. On EPC, it's heavy equipment, so you got cranes, you got other heavy equipment that comes in from related parties and is imported for the use of the project and then imported back out. So leasing also causes a lot of points of discussion with tax authority, and also requires careful documentation of the transactions within the company itself and within our clients. Misbah, if we could go to the last slide, and very briefly, whilst we are slightly overrun, the last slide really is sort of recapping something that we did discuss in one of our previous seminars, and those are available online, and you can view them in your own time. Tax treaties do allow, obviously, offshore revenue to be exempted from tax in Kuwait, subject to that clear definition of the split of onshore, offshore, the documentation, all of that being said. And why we're linking in this now is that, all these disallowances that we spoke of on Executive Rule 25, 26 on related party transactions and import of material from outside, design consultancy services outside. If you're claiming under a treaty, then all of that actually is not applicable. So what we say is that, if you have the treaty exemptions, yes, you need to keep the records, because under the requirements, the disclosure is still very much required. So your tax declaration still reports the onshore, offshore. You're matching your offshore revenue and offshore costs, making sure that only onshore costs are being claimed. It is only in the case where treaty benefits are denied, and we have seen that happen on large-scale contracts for various reasons. So where the treaty is denied, The expectation was at the front, at the outset, that, okay, offshore revenue will be exempted. But when it's brought into the tax net in Kuwait, these executive rules then start to apply to a greater extent. And then that really changes the tax profile of the project overall, with offshore revenue being brought in, tax authority applying imputation of profits on material, head office design engineering, which was not planned for. So these are again some of the issues that we see. It is definitely evolving at the Ministry of Finance. There are changes in practices continually. There are also variances between inspector to inspector. So it is something that needs very careful handling at the time of the tax inspection, based on the documentation that is available.
And I think the planning here is extremely important.
Yeah, go ahead. Sorry.
I'm just saying, I think this is where I think, as you said, the planning here is quite critical. I think before you sign the contracts, and the way this will be reflected in the contracts would really determine what's going to happen at the tax authorities, which I think we've seen at times at the time of contracting, these things unfortunately were not documented properly, and this has sort of brought about challenges. But I know we're definitely out of time, so probably closing on that, I think our next slide, Ms. Bai, is our slide which talks about. Yeah, I think we've had some interesting debate today, but I'm sure you would all agree that these are quite, again, this was a more technical session, and I'm sure there are further discussions to be had relating to either, if you're a Kuwaiti company, you may have foreign contractors who might be, liaising with you on these aspects, or if you're a foreign company, then you may want to talk about signing, any recommendations when you're signing a new contract, or if you're going through inspections. I think our contact details are available. So do speak to us. And yes, I think do give us the event feedback. That would be great for us to keep improving. And also do let us know any other topics you want us to cover, so we can focus that on our next webinar. And as you can see, we have done a doing business in Kuwait guide that is available. I think you can use the QR code to access that. So I think I would thank you everyone again for joining us, and thank you to our panel as well. And take care. Thank you. Bye-bye.
Thank you, everybody. Take care.
Thank you, everyone.
Thank you, everyone.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you, everyone.
Thank you.